We're going to discuss today net present value in early stage technical studies versus the market value for copper. My co-author for this was Bill Roscoe and Graham Clow, and the data compilation was extensive and was aided by Rosemary Delgado and Maria Campos. So the information used in this presentation is from a number of public sources, mainly CDAR and S&P Market Global Intelligence. But a bit of information was also gathered from company websites. The views expressed in this presentation are my own and not necessarily the views of SLR or other SLR employees. And lastly, the names of the copper properties have been excluded from the analysis, so not as to distract from the concepts presented herein. So many of you will be familiar with the PEA level studies. This is part of a typical stage gate where you see PEA followed by PFS or an FS, so preliminary economic assessment, pre-feasibility study, and feasibility study. But a PEA is answering the question what it could be versus a feasibility study or pre-feasibility study, which is answering a different question, which is what it should be or what it will be. The main objective of a PEA is to assess the potential economic viability of resources. And in particular, PEAs allow for the use of inferred, which is a key difference from the feasibility and pre-feasibility studies. The cost accuracy for these studies is typically low, the cost contingencies are high, and the proportion of engineering relative to the other levels of study is quite low. So basically, one measure of the overall risk of a project is the discount rate used for the economic model of your study. And so we looked at our previous work looked at those discount rates versus market values for gold. Then we revised it last year, Bill and I, looking at the differences between PEA and PFS level studies. That work yielded differences showing that discount rates or implied discount rates were lower for PFS compared to PEAs. So a de-risking effect, which is what you'd expect from the stage gate process in the first place. And then currently, this study is showing the same kind of analysis for copper. And at the end, we'll do a comparison of the copper versus the gold. So I think this is a great starting point for additional investigation. As Larry's slides showed, for the feasibility studies, not even the PEAs, they really showed that there is these low discount rates are being used for PEA level copper projects of 7 to 8%. The gold projects use somewhere in the range of 5%. And so how do we evaluate if 7 or 8% really represents all the risks inherent in a PEA level valuation? Well, we can do that in two ways. We can look at the NPV versus the deal price for transacted properties, as well as the NPV versus the market cap for non-transacted properties. And when there's a disconnect between these values, we can look at what discount rates would be needed to make the NPV equal to the transaction value or to the market capitalization. Now, one thing that's kind of interesting to think about throughout the presentation will be, well, how do the discount rates implied by the market compare to those derived from a risk-adjusted framework like Larry suggests, or to those used in actual arbitration settlements? So, when there's a project that gets appropriated by a government, when it goes into arbitration, what does the court use for their decisions? So just something to think about. So I'm going to just kind of go through quickly the methodology that we used and the scope of the actual analysis. So we looked at 30 gold properties last year. This year we were only able to look at 15. We had 11 last year that we were able to use versus the 8 for copper. So it's a bit of a smaller data set for the transacted properties. For the non-transacted properties, we started with 60 for gold. This year we had 37 for copper, and we were only able to use 14. So, it's a large starting data set, but by the time you whittle down the projects that you can actually use, it's actually quite small. And this is mainly due to differences in disclosure. To do this analysis, we need annualized cash flows, so year by year. Otherwise, it's not really possible for us to calculate the implied discount rate provided by the market. And then in addition, a number of other studies get excluded based on them being projects that have previously had a feasibility study or a more advanced study done, and then those same companies using a PEA to allow for the economic analysis of their inferred. And so in terms of the transactions, 2 were asset, 6 were corporate. All the NPVs are after tax. All the CapEx is also after tax and adjusted for equity interest in the property. And the important distinguishing feature between transacted and non-transacted properties are that the market caps are as of the deal announcement date for the transacted properties, and they are as of the PEA news release date for the non-transacted properties. So what does the analysis look like? For transacted PEAs for copper, we start with the deal price. We have an adjusted market cap value. So for some of these, the deals were within private entities, so you wouldn't have a adjusted market cap for those. We look at the after-tax NPV of the properties, and then we look at the ratios of the deal price to the NPV. And then we come up with some additional ratios for the adjusted market cap to the NPV. And so that's how we get those 2 columns. And then we also looked a bit at the ratio between the deal price and the adjusted market cap. And those numbers vary based on uncertainty of an announced deal, or they vary based on the option terms analysis that we use to calculate the implied value of the deals in the first place. So, and then here we take this information and we calculate the discount rate required for the NPV to equal the deal price, and the NPV, or the discount rate required for the NPV to equal the adjusted market cap. And so what do we see in our data set? Well, we see a fairly large disparity. You see NPVs that are dramatically higher than the deal prices that people are paying for them and the adjusted market caps for which they trade at. Scaled to a logarithmic scale, you can see that, yes, these bars are significantly different, and there continues to be almost this order of magnitude disconnect. So in terms of observations, we started with study rates for these PEAs at 5 to 7%, with a few at 8. In terms of the deal prices versus the PEA NPVs, the deal prices are consistently lower than the PEAs NPVs. The ratios average 0.16 with a median of 0.08. In terms of the adjusted market caps versus the PEA, obviously it was a smaller data set of only 3 properties, but you might not say that this is entirely reliable, but we got 0.06 and 0.06. In terms of the discount rates required for the NPV to equal the deal price, we had a range of between 6% and 26% for the deal prices, with an average of 13 and a median of 13. And I think this is an important note that when Larry talks about the risk-adjusted framework, he really sort of starts at a starting point for PEAs for copper of basically your base metal WACC of around 7 to 8%, followed by the study risk that you imply that brings it to around 10 to 12, and then you would put your risk for your jurisdiction on top of that. So it's kind of interesting that for North American properties that we were focusing on, we're kind of getting in this calculated range of around 13. So for the non-transacted PEAs, we took the similar information. So after-tax NPVs, adjusted market cap, we calculate the ratio, and then we calculate the discount rate required for the adjusted market cap to equal the NPV. And you can see here we actually have quite a broad range of values, and that in terms of both the the discount rates and the ratios. And some of the ratios are quite low, and then there's a cluster that are quite high. And I've added the operational scenario just to kind of give some context in terms of like, are there maybe differences between operational scenario and the kinds of ratios you see, or the kind of discount rates that end up getting calculated. And it looks initially like you get these higher ratios for underground, but really, as you'll see in my next few slides, I think that's a misleading initial indicator. So for the non-transacted PEA copper properties, we looked at discount rates of 5% to 8%. The adjusted market caps have significantly lower NPVs for all 14 properties. Has a broad range of both ratios of adjusted market cap to NPV, as well as discount rate required for the NPV to equal adjusted market cap. Our averages for the ratios are 0.15 and the median is 0.08. And the average is, for the discount rates are 20 and the median is 16. Oh, and just one more thing, I guess, before I continue. And so these are a bit higher than, these discount rates are a bit higher than what we saw for the transacted properties. And that might lend itself because of obviously a premium being paid for the transacted properties. Therefore, the actual discount rate required to equal the market cap would be lower. So what did we see with this data? Well, as I was talking about earlier, those underground being a misleader, I think what we have there are a cluster of properties that basically trade at their nominal value. So these are low NPVs and low adjusted market caps. So, if you have a property that is, your study is basically saying is only going to be, $10 million in terms of its NPV, that's not really, I think, all that exciting. And I think the market recognizes that. And especially if it's, using the study rates that we're using between 5 and 8%, if it's still only $10 million using those discount rates, I think what you see here is just a group of companies or properties trading at a nominal value. And then here we have higher adjusted market cap and higher moderate to moderate NPV. And so I think there is probably a sort of trajectory between properties that are sitting in the nominal value and sitting in the higher values. But then we have this cluster here, which are low adjusted market cap and moderate NPV. So that's a more interesting group of properties. So looking at it in a bit of a different context, we have the adjusted market cap to NPV ratio versus the NPV, and we sort of see a similar interesting distribution. We have those nominal properties sort of sitting right along the x-axis, and that again lower NPVs, they just hover right there. And then we have this cluster here that's kind of sitting off this trend. And then obviously this is a huge space, and I've just put in a line to fit. But in general, it does look like there is a nice little relationship here between these groupings. And so my last slide here is attempted to kind of figure out what's going on with those green properties. So I've colored the nodes based on their previous circles. So as you see here, the green, this is the green grouping that I've been kind of harping on about. So where does that fit? Well, kind of fits on this right on this axis, and we have a nice clear trend of the moderate to high NPVs sort of sitting in this comfortable range of 13 to 19%. But what's happening here? So you have these discount rates required to make the adjusted market cap equal the NPV, and some of these are like super high. Well, I think what we saw here in this grouping is just that these properties, the market is perhaps discounting them. That they've read the studies, they've looked at the information presented, and they say, hey, you know what? I think you're missing something. And this kind of goes back to what Larry was saying, which is these are disclosure documents. These aren't actual evaluations. And so in the process of reviewing the data, you get a property like this that might have some unquantifiable risks or unquantified risks when people are reading the studies. And so I think that's something to something important to consider. So in terms of a summary, transacted versus non-transacted copper, we typically see for transacted copper properties a deal price to NPV ratio of 0.16 with a median of 0.08. This is obviously a smaller data set for the transacted properties, and then we have 0.15 to 0.08 for the non-transacted PEAs in terms of their adjusted market cap to NPV ratio. We got good averages and around average and median around 13% for the discount rate for the deal price to equal the NPV, and we got 20 to 16 for the NPV to equal the adjusted market cap ratio. So how does this compare to the previous work that we've done on gold? Well, the one main note is that obviously the discount rates are actually quite similar, and that's in line with the graph that Larry showed earlier. So gold used a range from 5 to 8. Copper is using a range from 5 to 8. The deal prices for the transacted properties are to equal the NPV, or the deal prices versus the PEA NPVs are significantly lower across the board, but with the ratios for gold being much higher than those for copper. So that's like a first distinguishing feature, and that ratio persists again, both whether you're looking at deal prices or adjusted market caps. And then lastly, though, the discount rates required for the discount rate to equal the NPV of the deal price or to the market cap, they're actually like pretty comparable. They don't reflect the delta between the WACs necessarily, because you'd obviously expect the copper to be potentially higher than those for gold. But I think it's encouraging to see that they're actually plotting similar ranges in the mid to high teens. And then in terms of the non-transacted PEA properties, we have, again, a good disconnect between ratios. And this is probably our most robust data set. So 0.27 versus 0.15 for copper, and then the average being virtually identical for the discount rate to equal the NPV of the adjusted market cap. So why? Why do you think we get these varying ratios? And so one thing to look at is equity share of CapEx versus after-tax NPV of copper projects versus gold projects. And what we see is that typically the equity share of CapEx for a copper project is much higher. They do get higher after-tax NPVs, but the relative rate compared to gold is actually quite different. So it does appear that gold is offering a bit better of a bang for your buck. Obviously, you have these lower NPVs, but the risk associated with building a large CapEx project. And I mean, obviously, there's a huge range on this data with some really, really massive projects on the copper side, bringing up the averages. And so, but even if you look at the medians, you can still see the trend in the data that basically implies that there's some degree of safety, I guess, in gold. Although looking at what Guy showed in terms of the flaws for orogenic deposits, you might not think that there's a degree of safety. But yeah, how do these look when they're actually plotted on a graph? You can see a clear sort of trend line for gold here and then for copper there. And yeah, I think again, it's just sort of this perceived better bang for your buck on gold projects. So in conclusion, there's a disconnect between NPV values and deal values at PEA level copper studies, with the calculated rates being much higher than those used in studies of 5 to 8%. So what we've basically seen is an additional increment being added. The differences in the adjusted market cap ratio between gold and copper reflect a potential preference for an investor preference for gold projects based on their lower CapEx to NPV ratios. And then lastly, or second to lastly, there's only small differences between the copper and gold stage PEA properties in terms of the discount rate required to equal the NPV, and they sort of tend to hover in that 13 to 20% range. And then most PEAs on copper properties reviewed had that discount rate of 8% or less. And obviously, the conclusion here is that the data supports that increment is being added by the market or that an increment is being added by the market when the market is putting a value on the asset as opposed to the owner, and that that kind of leads to the idea that these are in fact disclosure documents, not evaluations. And and then to kind of tie back to my initial slide from the opening is just that what in practice, what rates are used when we look at those arbitration cases. And anecdotally from presentations by Howard Rosen of Secretariat at PDAC, he was saying that when a PEA stage project is considered using a DCF valuation as part of the analysis for valuing the compensation of an expropriated property, that we do get rates in the high to mid-teens. So I think a lot of the data in terms of risk-adjusted rates, our findings, and the actual compensation paid by courts all help support this idea that the real discount rates that we can be using to evaluate these projects are in sort of these higher ranges. That's it. Any questions?
Hi. Did you take a look at the mill prices for reasonableness, or comment on that? Because that's another thing that sometimes you see flexed and maybe outside of the realm of reasonableness in some of these studies, especially at the
Yeah, so that was kind of an interesting thing. I would say that what we did find when we looked at the prices, and you have to kind of look at a lot of different prices for this. So it's like you have to look at the price of. So we had the transaction dates and we had the PEA release date. And what we found was that there was typically like a very tight spread between within plus or minus 20%. So, we're for like the copper prices used for the study and as of the news release date or as of like the deal date. And so in some cases, the copper prices used in the study were conservative relative to the date issued, and sometimes they were unfortunately below. And so that does have an impact, obviously, on the how the market addresses or how the market receives the study. In the case of the adjusted market cap, you put out a study on the day that copper's $4, but your study says you used 250, and then people look further into your study and say, oh, look at the sensitivity analysis, this thing's going to the moon at $4. It's a pretty exciting release. But you get on the other side of that, it's the opposite. And if you're also thinking about whether or not we kind of adjusted for copper price, yeah, this is already a very intensive data collection. It breaks my brain to think about doing that kind of additional work. Any other questions? All right. Thank you very much.